Logan Hertz here with Hazeltine LLC. We're going to continue our whole life insurance policy walkthrough. This will be part two, and this is just a sample policy. I don't want you to conclude anything of this as gospel. And I want to keep reiterating this will not make any sense until we contextualize it in your overall financial picture. We're just looking at an individual product, an individual contract, and any individual financial product looked at in isolation doesn't make any sense. It's very difficult to see the most dramatic benefits of whole life insurance until you understand how it impacts the rest of your financial life. And of course, it has to be designed for you. But we're going to go through the contractual language because at the end of the day, this is a contract. We're going to pick up where we left off, looking at the IRR, the internal rate of return, which again, I don't think rate of return is a great metric. I try to get us away from it, but it is interesting to see that the rate of return on your cash value is competitive with a savings account, especially when you consider that this rate of return is net. It's actually better than a savings account. And if you account for all the other benefits you're getting, that rate of return number in real terms is significantly higher, depending on how much value you put on the death benefit protection, long-term care protection, creditor protection, the policy loan feature, the guarantees, tax benefits, etc. That notice how the rate of return peaks at around 5.12%. And then it starts going down. So the rate of return decreases. This is not something that happens typically in whole life insurance, but it does happen in this particular whole life insurance policy. Why is it that the rate of return decreases? The reason is because in this policy, we stop paying premiums, right? This is one of the reasons why you want the ability to continue to pay premiums in the policy, because the more you do that, the more you're going to increase the performance of the policy, especially in the later years, especially in the later years. The later years are the most efficient years of the contract. We want to make sure we account for that. And this is showing you what happens when you stop paying premiums, which is perfectly fine. There's nothing wrong with that. But I just want to point that out. I don't want you to conclude that the rate of return goes down as a whole life insurance policy matures. That's actually the opposite of the case. Everything about your policy gets better as that policy ages, as that policy matures. The reason why we're seeing this here is simply because we stopped paying premiums. We did a reduced paid up and we took income out of the policy. That was the trade-off. We reduced the internal rate of return. And in return, what did we get? We got all this income. We got $1.4 million of tax-free retirement income is what we got as the trade-off. That's particular to this policy, but that's an interesting thing to point out. Let's continue on the contract. This is a summary of the illustrated values, non-guaranteed values at year 20. By year 20, we've paid in $500,000 worth of premiums. We now have $824,000 of cash value and a death benefit of over $2 million. Year 40 in the policy, age 75. We already saw this in the supplemental illustration, but you can again see $725,000 of cumulative premium in the policy. At this point, in this example of the policy, we started taking income at age 66. So we've already gotten $720,000 of tax-free retirement income out of the policy. We still have $1.9 million in cash value available, and the death benefit has grown to over $3 million, giving again more of a summary of what we've already seen in the supplemental illustration. Keep in mind, because we're showing the retirement income scenario, that obviously impacts these numbers. This net cash value available could be a lot larger and the death benefit as well, but we reduced paid up the policy. So we stopped paying premiums and we started drawing income out of the policy. So that obviously is going to impact the net cash value and the net death benefit. Keep in mind, the gross cash value and the gross death benefit do not go down. They continue going up this whole time. That's very important. The net cash value is reduced just the same as your net equity position in your house is reduced when you borrow against it, but the total value of your house keeps going up. And if you're collecting rental income on the house, that keeps going up as well. We see the same thing here. Dividends, interest continue to be paid while you're borrowing against the policy. This is a summary at a couple of key ages of what we've already seen. Penn Mutual is the insurance company in this example. There are multiple carriers you can work with for which you can do infinite banking style policies. Penn Mutual is one of them. They're not the only one, but you do want to be working with a mutual insurance company, not a stock company, because then you become part owner of the company. And when you receive your dividend, there's not a stockholder in front of you. There's no stockholders that own the company, the policy owners own it, which makes the dividend much more meaningful, and one that has been paying dividends for over 100 years straight. In the case of Penn Mutual, they've paid dividends every single year since 1848. Just think about that for a second. They paid dividends every single year since 1848. These are bellwether financial institutions because their business model is based on actuarial science, not gambling in the market. So 175 years. This is summarizing the benefits of whole life insurance. You can read through this, some of these points we already covered. This is verbally summarizing some of the benefits of whole life insurance. You have the guaranteed death benefit that protects for your whole life, also your estate. It's great for estate planning as well. Consistent premiums. So the premium level is set for the life of the contract. You can set it to be whatever you want. And the cash value is guaranteed, and your access to it is also guaranteed. So the liquidity is phenomenal. It doesn't require the permission of a bank or anybody else. All right. Here's the policy owner. I'll go through some of the stuff in the superscript. Who is the insured? That's John Smith. This gives gender, age, and rate. The rate that you get is important. That's based on how the company underwrites you, which is based on your health, among other things. In this case, we have the best rating for this particular company, which is preferred plus non-tobacco. Then we have the contract premium mode. So how are you paying premiums? In this case, annually. You can choose. A lot of people choose to pay it monthly, but for simplicity's sake, we're paying it annually. Typically, the insurance carrier will give you a small discount for paying the premiums upfront annually rather than monthly. So there is a little bit of an incentive to do that. And the paid up additions rider, this carrier has multiple different paid up additions riders. APPUA is one of them. And notice there's a premium mode on that as well. So with this particular insurance company and most insurance companies, you can actually pay the premiums on different modes. You could pay the base premium monthly or annually and pay the paid up additions rider on a different mode. I have clients who run businesses and their cash flow is somewhat uncertain. They will pay the base or target premium upfront annually and then pay into the paid up additions rider as their cash flow comes in throughout the course of the year. So payments into the paid up additions rider are always optional. You have flexibility. Of course, we want to fully fund it so that the policy will perform optimally, but those payments are not required. And there's some, not unlimited, but there's some flexibility in how and when you pay those premiums. We have the initial premium of $25,000. In this case, the initial premium is the full annual premium. If we decided to pay it monthly, that would just be the first monthly premium. In order to put the policy in force, you have to sign for the policy and pay the first premium. Until you do those two things, the policy does not go into force. So that's the initial premium you pay to put the policy in force. If it were a single premium policy, that might be the only premium you ever pay. That's not typically how we're designing policies, but you can do that. There would be reasons you might want to do that in some cases. Then we have the initial base face amount. That is how much of that initial death benefit is your base death benefit. In this example, it's a little over $527,000, 527,000. Notice you also have what they call the flexible protection rider face amount. This is a term rider. Now, we're getting deep into the weeds, a little bit of case design, so I don't want to spend too much time on this, but basically we have 1 million or so in term life insurance that's included here. There are lots of reasons why we do that in order to make the cash flow efficiency better, in order to make the cash value growth better. There's a whole science and an art behind that when it comes to case design that you would need to be a life insurance agent or an infinite banking specialist like me to really understand all of that. But for the purposes of this overview, you have $500,000 of permanent base death benefit. That is a permanent death benefit. And $1 million of term stacked on top. Why do we do that? Well, the term is inexpensive. So we can stack that term rider on top of the base. And it's an inexpensive way to add more death benefit, which allows us to pay more premium and have more going into the paid up additions rider while still keeping the policy tax free. This gets back to some of the IRS rules that we have to navigate to make sure that the policy meets the IRS rules for life insurance, and therefore all the benefits, death benefit, cash value, policy loans are all received tax free. That's getting deep into the weeds. I don't want to go too deep into that. You would need to be an agent if you wanted to understand all of that. The key point is the total base amount then is $1.5 million. Of that 1.5 million, 500,000 is permanent base death benefit. 1 million is term. There are different types of term riders to confuse things even further. Some term riders fall off the policy eventually. So you might have a policy with, let's say, a 10-year term rider. Let's say at $1 million 10-year term rider. If you look at the illustration, what you'll see is in year 11, the death benefit drops by $1 million because that term rider falls off the policy. It was just term. Then you also have blended term, blended PUA riders, which is what we're using here. Well, what happens is over time, that term gets converted to permanent. With every premium payment you make, some portion of that $1 million of term gets converted to permanent, gets converted to paid up additions. And so over time, you're left with only permanent life insurance, only permanent death benefit. And so you'll have just basically a base premium and paid up additions over the long run. No, that's getting deep into the weeds. Speaking of paid up additions, what is the dividend option? It is paid up additions. Paid up additions. What that means is when we are paid the dividend, we can elect to receive the dividend in a lot of different ways. You could receive the dividend as just a check in the mail if you wanted to. We typically don't do that because then that becomes taxable income, and we don't want to pay taxes if we can avoid it. There are lots of different ways, but typically what we're doing is using the dividend to purchase paid up additions, which means we're reinvesting that dividend in the policy. And you could put reinvesting in quotes, but this is part of what gives the compound interest train that we're after. So everything keeps compounding in the policy. The dividend is used to purchase paid up additions, which effectively invests it back in the policy. So we never interrupt that compound interest train. And the dividends are now not just an income stream, but a compound interest machine over the long run in combination with the guaranteed interest rate that we're being paid. There's some definitions. The insured and the policy owner are typically the same. So someone owns the policy and then someone is the insured. In this case, John Smith is the owner and the insured. That wouldn't have to be the case. The policy owner could be anyone who has insurable interest in John Smith. You might have a trust own the policy. So John Smith is the insured, but the John Smith Trust owns the policy, his family trust. You might have a spouse own the policy. It could be a business partner. If John Smith took out a policy on one of his children, John Smith is the owner and his child is the insured. So the policy owner and the insured do not have to be the same person. And the policy owner can change. After you put a policy in force, you can transfer ownership. Just the same as any other asset you own, you can transfer it to somebody else. You could sell your life insurance policy to somebody else, or you could simply transfer it. The most typical case we see there is maybe a policy owner. He owns it himself. Eventually, he sets up a trust and he transfers ownership of the policy from himself to the trust. There can be very good reasons for doing that. And there are lots of different types of trusts, lots of different use cases for that. So that makes this even more valuable. What I'm pointing out is the policy is portable. You can transfer it to your brother, to your sister, to an aunt and uncle, your spouse, to a child, to a business partner, to a trust, an LLC. There could be a lot of different reasons you might do that. But typically, the policy owner and the insured are the same, but they do not have to be, and that can change over time. Once you own the policy, you could transfer it to anyone you wanted to. What state is it issued in? In this case, Georgia. The policy date is when the policy goes into force. Policy payment period, how many years are we paying premiums? In this case, we're paying them all the way to age 100, even though that's not what we've illustrated. So 65 years, so age 35 to age 100. Age 100 is the longest premium paying period that Penn Mutual will allow, and that's what we typically do because the passage of time is the most important element in whole life insurance because of how these policies mature. We want the ability to pay that premium for as long as possible, but it doesn't have to be that. It could be a single premium whole life policy. It could be a 10-year premium paying period. It could be a 20-year premium paying period. It's up to us to define that. But in this case, 65 years. The initial base amount is just repeating what we stated earlier, that $500,000 is the base amount. Guaranteed premiums. Unlike term life insurance, your premiums do not go up. No matter what happens to your health, no matter how old you are, those premiums stay the same. They are guaranteed. They are locked in. In this case, we have a $25,000 annual premium. That is guaranteed. That premium amount will never go up. Guaranteed death benefit and cash value accumulation. So the death benefit is guaranteed. Whenever you end up passing away, that death benefit will be paid out. We have a guaranteed result in this product. Unlike when you put the money in the market or other products, typically they don't have guarantees associated with them. Maybe your investment plan works out, maybe it doesn't. You really don't know what's going to happen. Here we have a guaranteed result. It's a self-completing plan, and cash value accumulation is also guaranteed as well. There's the dividends, which are not guaranteed, but there's also the interest rate, which is guaranteed. The cash value does grow at a guaranteed rate, and then on top of that, we are paid dividends. And then until the insured reaches age 121. So 121 is the maturity age. And if you were to live to age 121, the death benefit would be paid out to you tax-free. Whole life insurance policies used to mature and dow at age 100. And so there were people who received their full death benefit tax-free while they were still alive. The cash value is the net present value of the death benefit, and it's on track to equal the death benefit at maturity, which for these contracts in the United States is age 121. That is part of the reason why there's a connection between death benefit and cash value. Cash value does not grow independent of the death benefit. Death benefit grows and cash value grows together. An opportunity to increase the cash value and death benefit through non-guaranteed dividends. Dividends are being paid in addition to the cash value, but they're not guaranteed. Penn Mutual has paid dividends every single year straight since 1848. That's over 170 years, all through World War I, World War II, the Great Depression, the stagflation of the 70s, the 2008 financial crisis, you name it. But they're not guaranteed. I think it's extremely likely they will be paid, but dividends are not guaranteed. And what rate they will be paid at is not guaranteed. That can fluctuate. The flexible protection rider, I'm trying to stay out of technicalities and inside baseball. I'm trying more to just show you the general structure of the contract. But as I mentioned before, the flexible protection rider is a term rider. So you're stacking term life insurance, term death benefit on top of the permanent death benefit. I would have to go into some of the mechanics of case design to explain why we do that. You certainly don't have to do that. We could be looking at just a base premium policy or base plus paid up additions. For the policies I'm typically structuring, we are typically including a term rider because of how that optimizes cash value accumulation for infinite banking. This rider blends term life insurance with your whole life policy to help lower the cost of coverage and may enable you to purchase a higher death benefit. Term is obviously less expensive than permanent, coverage. So this allows us to inexpensively add death benefit which then over time becomes permanent. Your premium goes towards purchasing a combination of term life insurance and paid up additions. Over time, the term gets bought out and it all becomes permanent, becomes paid up additions. If the dividend is paid, it will also be used to purchase paid up additions. Over time, the amount of paid up whole life insurance can increase and take the place of the term life insurance, and that is what we're aiming for. If the premium for the rider is not enough to pay the full cost of the term insurance, the FPR death benefit could be lower than the coverage amount selected. And you could see that. I'll show you on the guaranteed side of the ledger when we get there. You sometimes might see a reduction in the death benefit. So the guaranteed side of the ledger would assume no dividends are ever paid. And if no dividends are paid, then that term doesn't necessarily get fully bought out. And so then we would see some of the term death benefit just drop off. The same as if you had a standalone term life insurance rider. That would be extremely unlikely, but it is possible. You might see a small reduction to your death benefit as a result. And this also is payable through year 65, just like the base premium. So age 100. So that was already a lot. It's going to take us a lot to go through this contract because I'm probably too detail oriented for my own good. And I'm trying to stay out of the weeds, but a lot of this will be challenging to explain without going into some of the weeds. So I hope this was helpful, not too detailed and technical and boring. We are on page 9 out of 50. Now, of course, a lot of those later pages we can skip over and go through quickly, so we won't have to go through all 50 pages. But I hope this was helpful. We will talk soon.